Welcome back everyone to our platform walkthrough. This time around, as promised, we're going to be taking a look at the deal order and alert. So picking up where we left off last time, we're also going to take a look not just at deal and order and alert, but we'll also have some items within the information section as well. So let's start with the simplest of them all. Let's start with the alert. And here there are multiple ways to set up an alert. You can either do it by price, or you can also do it if a certain indicator, for example, is crossing over price or over another indicator. But let's go back to price, and there are two types. You see a price level, and this one's quite straightforward. So, if the price crosses a certain level, in this case, let's go ahead and select. We can see the prices there. This is the bid and the ask. So 110.12.8, and that on the chart is the mid price because that's how we set it up last time. And by default, it's the mid price. But let's set up an alert at 1.1000. So 110, we're going to set it up right there. And we can also put a message there to remind us of what we're planning on doing. So at the beginning of the day, you can set up and say, all right, I want to consider selling one lot at this level. And now you set the alert. And it says, we'll alert you when your USD reaches 1.1. Now, this section right over here, the positions, orders, history, if you click on any of these items, it'll show you what you have. And in alerts, you'll see that there are three subsections. So price change alerts, price level alerts, and there's our order. And you can change it, by the way. So you can change it from there. You can increase, decrease. So if you feel like you want to change the alert, you don't have to set it up from the beginning. And you can also close it and delete it from there as well. Let's go and take a look at the other type of change, and that's price change. So what if price changes by a certain percent? So if, for example, we're more interested not in whether or not price will cross a certain level, but whether it changes significantly. This is especially true if you want to look if it's going to change by 1%. And you can also do it based on change in points, so not necessarily in percent. But let's go back to percent for a second. Let's say it changes by, want to take it by 1%. And then we can notify ourselves and say, all right, your USD, it's down. It could go up, actually. So it could go up or down by 1%, but it's changed by 1%. So let's go ahead and do that, and we can set up the alert. And once again, it's going to be there in our alert section, but it's going to be under price change alert and not price level alert. So our old price level alert at 1.1, it's still there. And indicator alerts, we haven't set one up yet. So let's go ahead and, well, let's set one up. And in this case, you can look at it in terms of what the time frame is going to be. So selecting the daily, and let's choose our indicator. Because of the fact that we looked at moving averages, let's just stick with moving averages. So alert me when the period, the 20, or in this case, let's take the 50, that's a very popular one, is over, under, or crosses. And here you can choose the period. You can say whether it crosses a certain period, value, or market price. So let's say, for example, I want to, and depending on what you choose, different things are going to come up. So let's take market price. And so whenever it crosses the market price, then it's going to go ahead and alert me. And I'm going to show it on the moment when we add the technical indicators, but we can put there in the alert section, we can put a comment, and we're going to go ahead and set up the alert. Now, so let's go ahead and pull up. Last time we looked at technical indicators, so we should be familiar with how to set those up. You can see that there's the 50-day moving average, and so if price crosses back up, then we'll go ahead and look at that. It shows up right there in indicator alerts. So if we don't need them anymore, we can go ahead and delete these alerts, go ahead and clear them. There is something else, though, that we want to add. And I know before we get into the deal and order section, and that is a lot of times that you don't need an alert just for the market that you're trading. It could be for another market that's related to your market, but you're not actually trading. So let's say for a moment you're trading USD/JPY, and the yen is a safe haven asset. It runs usually contrary to riskier assets. Let's pull up the Dow as a Wall Street cash in this case. So sometimes you're trading USD/JPY, but it's influenced by what's happening in the Dow. If the Dow is really strengthening, the yen could be in somewhat of a retreat. So what you want to do is you want to say, all right, fine, I'm focused on the charts in USD/JPY, but I want to know if a significant move is happening within the Dow. So if the Dow changes by, for example, 1%, then beware. So an alert doesn't have to be in the market that you're necessarily trading. It could be used in a market that's related to the market that you're trading, and that's something to know. So what we're going to do next is we're going to go ahead and we're going to close out those two tabs. We don't need those anymore. We're going to switch back to Euro USD. We're going to go ahead and delete the alert because we don't need it anymore. And we're going to go ahead into the next section regarding trading, setting up your trades. And here you can see that we've got dealing. That's if you want to set an order right now, and orders if you want to set it when price reaches a certain level. So let's start with the simpler of the two, so to speak. Let's start with dealing. You want to place a trade right now. Let's get active. Let's get some action going. And in this case, first thing, let's see if you want to put a buy and you want to put in your size. And you remember, we're going to get to the information, but remember how that tells you what the price per point is going to be and what the size of the contract is. And then you have what's called a stop loss. And there are two ways to do it. You could either do it points away or based on dollar loss. Let's stick with points away first of all. So let's say I'm going to sell it. I'm going to buy at around 110.11, but I don't want my stop loss to be more than 20 pips away. So in other words, I want it to close out when it reaches 20 points below my current buy. Same thing and when it comes to the limit, I'm going to put 30 points. I want it to go 30 in my favor. And you can see right there what the margin is going to be. And when we place a trade, you're going to understand in the context of your funds and everything what that margin is going to represent. Your resulting position in this case, because you're buying one lot, your resulting position is going to be +1. So here we place the deal, it's in place, and you can see it right there on the chart. I click on it and look at that. One thing I can do is I can close it right there if I don't want it, and the second thing I can do is I can change the limit and the stop on the chart. So if you really want to get a trade in right away, you don't need to think too much about it. You can put it in, and afterwards you can adjust it, and it'll show you the risk reward ratio. Look how it's now 1-2. So I'm risking 1 to make 2. That's the ratio, and I can move the stop. So now it's 1-1, and I can change it back and forth. Ideally, you don't want to risk more than what you're going to make. That's something we'll discuss when it comes to risk management and strategies. So let's go above, and now let's go through the items. Now our funds, we got $20,000 in this case. This is a demo account. It's a simulated environment. Our loss right now is $2. Our margin, this is in terms of our margin and what's available. So now if we want to initiate new trades, we've got $18,701 in order to use up there. So our equity, we haven't lost that 1,296. It's just used up towards this position. Our funds is 20,000. We're down $2. So our equity is 19,998 because we've got $2 loss there. So that equity is going to keep moving, by the way. The funds is going to stay the same, but the equity is going to keep moving depending on your profit and loss. And so too will your margins depending on how the contract reacts. If you want the equity up there, by the way, as we discussed in part 1, you can click on it. It'll come up. But in this case, if we don't need to see it up there, we can just click on it again and the checks will be gone and we're back to our standard view. So another place where you can see your positions. So in case you're looking at other charts and you don't know exactly what positions you have available, you can open positions. And again, you can change your stop and limit from here. But of course, it's much easier on the chart because the risk reward is there. So it's just so much more convenient to do it on the chart. So let's go ahead and we're going to put a sell position in here, and let's go ahead and sell 2. We're going to set a stop, and what we're going to do is we're going to try this other feature, USD loss. So I want my stop loss to not be more than a certain amount I don't want there to be more than this amount of damage, $200. If that's the case, if I put 200, that's where it would be, but let's go ahead and say $500. And my limit, I want my profit in dollars, not in points, in terms of how many points away, but in dollars, I want my profit to be 600. Notice the resulting position is -1. Now you're going, hang on a second, we're selling 2, and that's because we already have one buy open. So we have a buy position open over there. So if we now sell 2, we're going to be left with a resulting position of -1 with one position short. And this is where net off and force open come into place. So we're going to do 2 examples, one where we got net off, and one where we're going to have it with force open. We're going to place the deal with net off. And what happened is, because we had one buy position, we then initiated 2 sell positions. One sell position closed the buy position, net off, they netted off, and now we end up with one sell position. So you're saying, I put an order in for 2 sells. Yes, but you had one buy position open. So one of those sell positions got canceled with a buy, and this is what we're left with. We now have the resulting position is -1. We have one lot as a sell position. Now, what if you say, well, hold on a second, I don't want that. Now, in settings, by the way, the default is net off. But you could select force open if you want the default. We're going to keep it net off, but you could make it force open, and it explains there what net off is. Trades will attempt to close any opposing positions before a new position, whereas in force open, trades will always open new positions. Because sometimes you guys will say, no, I want to open a long, I want to open a buy and a sell, and I want to keep both open. I don't want them to cancel each other out. That's fine. Keep it. Then what you need to do is you need to select force open. So let's give an example. We now have a short position in the market. Let's buy, and we're going to go ahead and buy one lot, and we're going to put a stop. Well, let's not put anything. Let's just go quickly in, and now we initiated a buy. So now we've got two contracts. See the +1 and the -1? We have a buy and a sell open at the same time, and that's because we selected force open. So if you want to keep both open, you have to have force open, and you have to go to settings and make the default force open if you always want that. Otherwise, they're going to net each other out. So let's go ahead right now. Let's close these positions. Let's go ahead and close those positions, and now we're going to look at one click. So what exactly is one click? Well, you can see now that when I want to buy or sell, I have to go to the deal and initiate the buy and the sell. But let's go ahead and click on one click. It'll explain there, and you can deal directly from the chart. And we'll do an example in just a second. Let's go ahead and enable that one-click trading. So let's click on that. We're back to one-click trading, and let's go ahead and initiate a sell right off the chart. You just click right there, bam, I have a sell position in place, -1. You can put the volume right there, and you can change it. Of course, you can go with 2 lots if you want directly. And this happens when something's happening very quickly in the market. You don't want to wait. You want to go ahead and you want to initiate right away. And by the way, after you initiate the position, if you say, okay, I want to put a stop and a limit, you can do that. So this is about getting into the trade as quickly as possible. Again, it depends on your trading style. Let's go ahead and close these out, but that's something you can do with a one-click option. You can deal directly from the chart. Now, let's talk about other stops. What we had before was a normal stop, a stop loss, but what we can also put is a guaranteed stop loss. How does this work? A lot of times the market will jump, and because you've got significant news like U.S. non-farm payroll, or you got a European Central Bank announcement regarding this currency pair. So now we're going to put a guaranteed stop of 20 pips. Last time we had a normal stop of 20. This time we're going to put a guaranteed stop of 20. And what that means is when this market makes this jump, above or below, in this case, because it's a stop loss to the downside, but when it makes a move downwards, sometimes the market can gap, and it'll jump past your stop of 109, 92. So it'll jump past it, and you won't be able to get that stop price. You'll get stopped out at a lower or worse price, and that means you end up losing more. So sometimes you say, well, I don't want to take on that additional risk. I want to guarantee that I'm going to get stopped out at that level if price goes against me. And of course, you can move it accordingly. So when that happens with a guaranteed stop, the thing that you have to keep in mind is, and of course, you could go for normal, but we're doing guaranteed and at 20. But one thing you need to know is that there is going to be a stop premium. You are going to pay a slight price for it, a premium for it, if it gets triggered. So you're only charged if your stop is triggered, and it'll tell you there how much you're going to get charged. If things are getting volatile, keep in mind that premium, when you're initiating, if it's about non-farmer at that time, of course it's going to be higher. So keep that in mind. And now we're initiating the deal, and you can change things up as you please, just like you could with a normal trade, only this time the stop is guaranteed. Up next, let's take a look at a trailing stop. So let's go ahead and close this one, and let's take a look at a trailing stop. You put a sell in, and the difference really with a trailing stop is that a lot of times you want to lock in your profit. So market moves in your favor, but then it starts to go against you, and you don't want to miss out on those gains. So let's go ahead and do this by example. Let's put a trailing stop of 20, our limit of 30, but the trailing step, by the way, the resulting position -1, no surprise there. But so when market is going down, because it's a sell position, when it's going in your favor, a lot of times you don't want to miss out if it's going to go back up. You want to lock in that profit. So how do you lock it in? Well, you put this trailing stop in, and when the market goes in your favor by a certain amount, that trailing step, then that trailing stop starts to move up. That's trailing, or in this case, because it's a sell order, the trailing stop gets pushed lower. So that way, if market goes against you, it's not going to go all the way back to 110.31. It's going to go, and if you get stopped out, it could be even, you could even get stopped out in profit if the market goes significantly in your favor. So let's go ahead, let's close this out, and let's go to the next main item, and that's order. Now we want to place orders, whether it's a buy order or a sell order, limit or stops, and let's go through all of them. This is before price reaches the level. So let's put a buy in. We have the size, and now we have to put in a price level because you want to choose where you want to buy. So let's say price now is at 110.12. We want to buy at 110.50. So if price reaches 110.50, we want to buy. And here you have two choices. Good till a certain date. So for example, you say only if today it crosses 110.50. Tomorrow I don't want to buy. I just only buy the end of today, and you can select till what date. But if that's one way to do it, good till date. But a lot of times what will happen is we say good till canceled. And that means that until you specifically cancel the order, which we'll show you how to do in a moment. But let's go ahead and place this order initially. So we're at 110.50, and you can put a stop loss and a take profit. You can say, okay, when it reaches 110.50, I want to have a stop loss of 110.30, and I want to have a take profit of 110.80. And in this case, this is going to be a buy stop order. If it's below market price and it's a buy order, it's going to be a buy limit. Also, you can choose normal or guaranteed stop, just like you can with a deal position. But let's go ahead. In this case, it's saying place a stop order. If you place a buy below market price at, let's say, 109.50, so if price goes down, it's going to be a limit order. So let's go back to 110.50. Now it's a stop order. So if it goes above, you could get 110.50. But again, keep in mind that if the market gaps higher, and this is especially true when you've got like earnings releases for shares and stuff, when it gaps higher, you may not get that price. You will get a higher buy price. Now let's take a look at the sell side, because what if price drops and you want to initiate a sell? Well, to do this, again, same concept. If it's below market price, though, it's going to be a stop, not a limit. And if it's above, let's put it 110.50. If it's above, then it's going to be a sell limit order. So above market price, limit for a sell position. Above is going to be a limit. Below is going to be a sell stop. And keep in mind again that you may not get the price that you have set your sell stop at because the market could gap. So let's go ahead and close these positions up. And what I'm going to do is we're going to place an order. And what if you want to remove those orders? This is especially true at the end of the day. You might want to do is make sure you don't have any orders there. I've seen this happen a lot with traders who, they put on these orders and then end of the day, check your positions, make it a habit, check your positions, check your orders. If you have any open orders and you don't want them there, it's best to close it. You don't want to wake up the next day and something's happened and your order is stuck. It's not a pretty sight when especially if the market's going against you and and also check your alerts, clear out your alerts. So that's deal, that's order, that's alert. Lastly, there's information. And you remember how we talked about margin requirements and things like that? This is where you'll find it. So for every product, you'll find your margin requirements here, from, like in the case of Euro USD, 0 to not 11.5 actually, but to 115. The deposit factor is 2%, so 1 to 50. Margins could be reduced, and it does discuss that, whether when you don't have a stop or if you have a stop, or if you put a guaranteed stop, the margins are going to be different. So it is going to be less if you put a stop loss. Keep that in mind. So if you're initiating right away, yeah, your margins are going to be higher, but when you put a stop or a guaranteed stop, those numbers will come down. Okay, so that's it. Up next, we're going to talk about the dashboard My IG. Stay tuned for that from all of us here at IG. Thank you so much for watching.